Hello guys, we have some big news. India just hit 10 crore demat accounts on both its depositories. That's 10 crore investors that have hit a new record. On that note, we are starting a new series of stock market FAQs from beginner to advanced, which will answer all your questions from day one.
So hey guys, my name is Kritish and this is Karan with me, and today we'll be answering some of the very basic questions related to stock market. But first of all, if you are new to this channel, please subscribe. We will be publishing more interesting investing and trading videos on this channel. So Karan, should we get started?
Yeah, let's get started. So we've come up with a list of very basic questions for the first part of this series. So it doesn't matter if you don't have any prior investing knowledge or trading knowledge. You can watch this video from the scratch and we'll explain some very basic questions that anyone would be wondering, whether you're an investor or a speculator or you're just interested in the markets. So here's the first question. Okay, this is a question that everyone asks. What is the stock market?
So a stock market is a place where a company can offer its shares to the public to purchase. For example, from everything from shoes to banks to oil, there is a company behind that product. Let's say for your shoes, there is a company Bata. For banking, HDFC Bank. Even if you are looking into petroleum, there is BPCL, HPCL. So there is a company behind all the things, products and or services that you are using. So if the company needs money, they can go directly to the people and ask money from them, and this can be done from the stock market. So basically, in other words, we can also say that this is a place where people can buy the shares of the publicly listed company. So for example, if you want to buy the shares of Reliance Industries, you can directly go to stock exchange, you can purchase there. There are a lot of startups in the Indian ecosystem, and if they want to offer their shares to the public, they can also go to the share market. Let's say Ola, it gets listed in share market, they can offer its shares to the public, and public afterwards can buy and sell the shares of Ola. So basically, it's a place for the company to get listed and offer its shares, and for the people to buy and sell the shares of their favorite companies.
So we spoke about Ola just now. So there's a question that I picked up online, which was, why can I invest in shares from the Tata Group, but I can't invest in shares of Ola?
Okay, so here there are two types of companies. One is a public company and second is a private company. So the public companies are those companies which offers their shares to the public via the share market. So most of the Tata Group companies, Reliance company, HDFC company, these are public companies, these are not private companies. They have offered their shares to the public, so you can buy these companies. On the other hand, there are also like lakhs of private companies which are owned just by the promoters or the family owners or few limited number of people.
Private players.
Private players. For example, our company also, we are listed as Daily Raven Technologies, and here it's a private company. We have not offered the shares of our company to any outsider, and we are not listed on the stock exchange NSE BSE. So in our case, you cannot buy the shares of Daily Raven Technologies. Similarly, Ola, Oyo, Flipkart, these are currently private companies. These are owned by just few limited players. Along with there are big investors like angel investors, VCs who have very big money, but it's not available for the common people. If they want to offer their shares, they can go to stock market, they can do an IPO, and afterwards you can buy their shares. But because they are a private company, they are not entitled, you are not entitled to buy their stocks on the stock exchange.
Until they become listed.
Until they become listed, yeah. So a lot of startups are planning for their IPO. So if they go and listed in the stock market, if Oyo or Ola get listed on stock market, after that you can buy. And most of the companies, if you see, like initially they start as a private company only. Infosys, TCS, they got listed in 1990s and all. Before that, it was only privately held by few people. And after that, they started selling shares to the public once they become stable, matured and all. So these startups also are only like 5 to 10 years. Once they become mature, they can also enter the stock market, and after that people can buy their shares.
Agreed.
I hope this is clear.
Yeah, it is. It is definitely clear. Okay, very good question. Why do prices move? The share prices.
Okay, so whether it's a stock market or a vegetable market, the prices is also always based on demand and supply. So let's say if we look into the prices of vegetables, onion, if the supply is very high, if there are like tons of quintals of onion,
Yeah.
and buyers are only less, there are only few thousands of buyers, obviously the prices will go lower because a very less number of people want to buy those onions.
Yeah.
On the other hand, if the buyers are very high, very much, and the sellers are very few, let's say thousands of people want to buy onion and only 2 people is selling, 2 vegetable seller is there, price will go higher.
They control the price now.
They control the price. Same thing happens in the share market also. It's always the game of buyers and seller. How much is the demand and how much is the supply. The only thing matters here is like what affects demand and supply. So let's say demand is the buyer who wants to buy. It can be various factors. Let's say there's a very good news about the stock. The company has given very good results, or there is something good happening with the company. In that case, the demand will increase. On the other hand, if there is a very bad news related to the stock, if there is some bad results coming on, or there can be multiple factors because of that, their supply can be more, or people want to sell that share.
Yeah.
So it continuously keeps on happening in the stock market. The supply will be there, demand will be there, and at a price where it matches, then the transaction is happening, but it keeps on changing. A lot of time it is also because of trading psychology. So there are a lot of active traders in the stock market who continuously buy and sell, and they also can be able to look into provide supply and demand. So because of this, demand and supply keeps on changing. It never matches, and right now, like you have said, we have crossed 10 crore users, people. So such a big people, you cannot match the psychology of all the people. A lot of people will be bullish that this company will go higher. On the other hand, there will be a lot of people who will think that this is not a good stock, it will go lower. So because of that, there will always be a demand and supply mismatch, and always the prices keeps on fluctuating. But if there is always a great demand, if there is a very good news, demand is increasing, the company is continuously performing better, in that case demand will keep on increasing and share prices will keep on going higher, and vice versa.
Yeah, that clarifies price movement. This is a very good question. I'm sure everyone has this question in mind. Do companies get the money we use to buy the shares?
Basically, the first time when the company offers this, their shares to the public, let's say IPO time, in that time the entire money is gone to the company. So during the IPO time, the buyers are the people and the sellers are the company. So if you are coming with 1,000 crore IPO, it directly goes to the company. That is the only time in which the company directly gets the money. The thing is that most of the promoters, board of directors, they have a very majority stake in the company. For example, Reliance Industries, Mukesh Ambani has 51% stake. So even if they are not directly getting the price, if the price is moving higher, they are getting benefited. Indirectly. Board of directors, a lot of employees will also hold the shares of the company, ESOPs are there, so different options are there. So that's why the company and company board of directors, CEOs, employees, they will always want to push their share price higher. Maybe they are not directly getting the money. Generally in the share market, the buyers, sellers can be anyone, normal people. I will buy, you will sell, and all transaction is happening between us. They are not directly getting the money, but if the share prices are getting higher, they are also getting benefited.
This will shoot up their net worth.
But only during the IPO time is when the buyers, sellers are company directly getting the money. After that, in normal transactions, it's just the buyer and seller, normal people who are buying and selling.
Yeah, that clarified it. Yeah.
Okay. Let's move forward.
Yes, let's go for the next question. Okay. What are the market timings?
Okay. In India, the normal market timing is between 9:15 a.m. to 3:30. So between this time, you can do your normal trading or investing that you want. However, the opening time is 9:08 a.m.
Okay.
So at 9:08 a.m. you can know whether at what price, at what range the market is opening. Regular trading will start at 9:15 only.
When the opening bell hits, then?
Yeah, opening bell, you can start making trades and all. And the market is closed on weekends, Saturday, Sunday, and all the national holidays, Independence Day, Republic holidays, Holi and all. They do give you a calendar on which days they will be closed.
Both exchanges.
Both exchanges.
Yeah. Next question. We get interesting more and more.
Okay.
Difference between a company, a stock, and a share.
Okay. So basically, company is an entity.
Yes.
Whoever is providing your product and services, and maybe listed or private, it can be considered a company. HDFC Bank, Reliance Industries, Trident, Tata Communication, TCS, all these are companies. Shares and stocks are basically the same thing, whatever you say, and it represents the value of the company, one quantity of that value of the company.
That share, that unit.
That unit. For example, currently for if you see ICICI Bank, one share is worth around 890 rupees or 900 rupees. So it just represents at what value one quantity of that share is selling. But company on in total is like the whole entity, everything, assets, liabilities, everything that become. Equity, shares, stocks, all are basically the same thing.
Okay, that clarified the difference to a lot of people.
Yeah.
Can I enter the company headquarters if I own the shares?
Okay, so the thing is like a company can have like 500 crore or more shares also, and if everyone starts coming in the headquarters, it will be a big mess. So basically, if you are owning the shares, if you are a shareholder, you have some rights, but you cannot enter the company. You cannot go and talk to directors. They let them do their work.
Which is making you money.
Making you money, but you cannot directly go to the headquarters. But there are some advantages that you get as a shareholder.
Voting rights.
Voting rights, dividends, along with that few other things are also. For example, Bata gives you a discount on their shoes.
Yes.
So if you are a shareholder of Bata, they will send you coupons and all on your email ID, registered email ID, and that you can use to get benefits.
For their products.
Similarly, Trident, they have towels and all. They also give, if you are a shareholder of Trident, they also give you some discount. So there are a lot of companies, a lot of common stocks which provide these benefits to the shareholders. But obviously no one allows you to come and
not allowed to headquarters. Why is there a price difference between NSE and BSE?
Okay, on NSE and BSE the difference happens because of supply and demand again. The number of people buying on BSE and NSE or selling on NSE can be different. So if there are more buyers on NSE, it means and there are less number of buyers, the demand is available on BSE, it means that the price will be little higher on NSE compared to BSE. So there will always be a scenario where the supply buyers and sellers will be different on NSE and BSE. However, the difference will not be too much. Let's say there is an example, let's say that there is a significant difference of 2 rupees or 3 rupees on two of the platforms. In that case, what happens that people will from NSE, they will start switching from NSE and start buying on BSE. So that will adjust the prices.
Okay.
So whenever some price is increasing on one exchange, the people, buyer or seller, will move to the other to get benefit of that one. But they will make sure that the difference is not that big. So yeah, always there will be difference because of if there are 50 lakh buyers and sellers on NSE, maybe it can be 40 lakh on NSE. So because of price difference, demand and supply, there will be difference, but there will never be a very significant difference, and not for a very long time.
It's very negligible.
Very negligible. So this is also called arbitrage trading. So a lot of people, what they do, if they are able to find opportunities where the share price has a significant difference on NSE and BSE, they will buy on NSE and sell on BSE. So that is allowed. You can buy on one and sell on other, and there you can get benefited. So this is also very arbitrage trading that you can do. But generally there is not much difference in the share price of the company.
The price spread is very less.
Very less, and that too it happens in seconds. Like the moment you try to I want to book on this price, it will change significantly on that moment, and you will not be able to book the difference on that one. You need a very good system, fast placement and all if you want to do arbitrage trading.
Like a proper trading system.
Proper trading setup.
This being said, while we said that there are 10 crore demat accounts, this is not necessary that all 10 crore are on BSE or NSE or it's equally spread. There will always be a fluctuation between buyers and sellers on each exchange, and that leads to a price difference. So this is an interesting question. Is the stock market owned by the government?
Stock market is regulated by the government. SEBI do take care of that one, regulations and all. But both of NSE and BSE, if you look into, both are private companies.
Yes.
BSE is even listed on the stock market. NSE is also planning to go get listed. BSE is a public company, even anyone can buy those shares. Quick fact, Zerodha, one of the biggest stock broker in India, they hold a significant stake in BSE. I think 4 to 5% stake.
Yes, that's right.
So these are not public, these are not owned by the public, owned by the group of board of directors and all.
So it's regulated, but of course not controlled by the government.
Yeah, it's regulated but not controlled.
And the next question. I hope this is clarifying your questions, you guys who are watching back at home. Can my shares turn to zero?
Technically, like no, it can't go to zero. But we have seen cases like Yes Bank. It has drawn from 450 rupees to almost 14-15 rupees.
Penny stock, basically.
I mean, 99% erosion of your wealth. So there are cases where the price can go erode from 100 rupees to even 2 to 3 rupees. Technically, it can also go to zero, but rarely it happens. In some cases, the company gets delisted from the stock market. That is, they do not exist in the share market anymore. In that case, if you are holding the shares of those companies, it might be a total loss for you. Selling a delisted company is very difficult, and most of the cases it's not possible. So that's a totally different case. But generally, the price can fall 90-95%. We have seen cases of Vodafone, Yes Bank, Reliance Communication. 90-95% is possible. Even it can go to zero, but we haven't seen that much cases.
Yeah, and there are also cases where like it doubles and triples your money also. So
doubles and triples, and most of the good companies will give you good returns.
Over time, if they're building value. So,
fundamentals are degrading. Do not hold it for a very long time. Like Reliance and Communication and all, it didn't happen in 2 days. Vodafone, Idea, Yes Bank, it didn't happen in 2 days. It gave you time for 1 year, 2 years for all the downfall. If the fundamentals are decreasing, maybe cut the losses in 30-40%, 50% loss, book the loss and all. But do not hold it for a very long time.
This being said, there are close to like 7,000 companies, so there'll be ones that will make you a millionaire, or there would be ones that make you become a pauper overnight as well.
Yeah, they need to find those companies. But both are possible. We have seen a lot of people who have lost significant amount of money in the stock market. And there are a lot of people, we have already seen so much example who have made significant money, even they have safeguarded a very big corpus for their retirement, for their future plans and all. So both opportunities are available. It depends on how you take it.
Yeah, interesting. Since it's going back on NSE and BSE. What is SENSEX and NIFTY?
So basically, SENSEX and NIFTY are the barometer of the market. Let me explain in other words. So like you said, there are 5,000-6,000 stocks in the stock market. And it's practically impossible to track all the stocks in order to say how the market is performing, whether it's going higher or lower. So that's why the BSE and NSE stock exchanges created indexes. So index, SENSEX and NIFTY both are indexes. So what they do is they look into the top 30 or 50 companies. In case of SENSEX, they look into the top 30 companies, track all the 30 companies and find out whether they are going higher or lower. So if all those 30 companies are going higher, it will drag SENSEX higher, and overall you can say that the market is going higher. Similarly, in the case of NIFTY, it takes 50 companies of National Stock Exchange, top 50 companies, and it also tracks all the 50 companies. So if all the 50 companies, majority of them are doing good, going higher, NIFTY will go higher. If majority of them will perform poor, then the NIFTY will go lower. So basically, you do not need to track all the stocks. If you want to know the mood of the market, how the market is doing, you can just look into SENSEX and NIFTY in the morning, whether it's red or green, it's going higher and lower. And you can say that the biggest companies in India, the top companies in India are doing good, they are going higher or they are going lower. So that's why NIFTY and SENSEX was basically created to overall track the market.
So this is the public definition of when people say the market has gone up today, the market has gone down today.
So whenever they are saying the market has gone down, they are generally referring to SENSEX or NIFTY. SENSEX has gone down up or NIFTY has gone up. So it's not necessarily like all the 30 stocks will go up or all entire 6,000 stocks will go up on that one. Only the majority of the stocks in NIFTY and SENSEX, they has gone up on that day. That's what they are referring to.
Yeah, that is clarified as a basic understanding of SENSEX and NIFTY. Okay, this is a very good question. I'm sure all of you have been waiting for this. Why should I invest?
Okay. So you cannot beat inflation if you do not invest in stock market. Basically, if you see in your savings account, you are getting a return of like 3 to 3.5%.
Yes.
On FDs, on a good note, you get like 6 to 6.5% return, and that too taxable.
Yeah, taxable, yes.
So, and the inflation currently in India is like 7 to 7.5%. So, all of these are degrading your money only. If you want to outperform the returns, you have to invest in stock market. So, even if you see the average returns, not a very high returns, average returns of SENSEX and NIFTY, generally they can give you anything between 12 to 15% return. And this is 4 times what you are getting from return on your savings account.
Yes.
3% to 15%, that's a very big difference. Even if you like on the lower note also, if you go like 12% also, that's also significant difference on what you will be earning from FDs and all. And when you take it for the longer duration, compounded over year for next 20 to 30 years, it becomes a very huge difference.
Yes.
3.5% return for 30 years and 12% returns for 30 years. The corpus will be totally different.
Yeah.
And I'm just saying like this is the average that you can get. Most of the people who are doing due diligence, who are doing fundamental analysis and giving proper time for research, they are even able to get 20 to 25% return on the market. So it depends also on how much return and how much effort you are willing. So you can always outperform the market. But even if you do not outperform, even if you get average returns, still it's way bigger than what you will get after inflation is the worst. So if you do not want your money to degrade, investing is the only option.
Yeah, I hope whoever has not started investing, this gives you enough motivation to do so.
Yeah, one more thing I would like to add, even if you are getting a 12% return and you have a investment amount of 10 lakh, you are getting 1.2 lakh extra in a year.
Without having to work, by the way. Just you making your money work for you. So you're not having to put in extra days. All you're doing is putting your money in the right place and you're getting a return.
Yeah, you would have kept it in your bank anyway.
Yes, exactly.
So putting it in the better place and getting that much higher return is always good.
So on the back of why I should invest, what qualifications are needed to invest?
Basically, like there's no general qualification. All you need is to learn some skills, some knowledge, and having interest in the stock market. But there is no domain requirement, like you do not require to be an MBA in finance or commerce to start investing in the stock market. In my case also, I'm an electrical engineer, so that's a totally different domain from finance and all. So overall there is no requirement. Basically anyone can start investing. All they need is good knowledge, skills, and the deep urge to learn and invest in the stock market.
And make money.
If you learn from the market, you have your entire life to make wealth.
Yes, so there's no age limit as well.
There's no age limit. Even if you are 30, you can invest for the next 40 years. So the learning that you are getting is the most important thing.
Yes.
Wealth can be created in your entire lifetime, but if you never intern, if you never understood how it works, you are just losing the opportunity.
Yeah, and if you're not aware, then you lost something that you didn't even know about in the first place. Yeah, which is a bigger loss.
Bigger loss.
Yes. Why are there bulls outside the stock exchange? As in the golden or the bronze bull statue that we see.
Okay. So stock market is generally signified by the bull. So bulls are basically the people who are very optimistic and who believe that the market will go high. And definitely you will want that the market should go high. That's why there are generally two types of people in the stock market. One is bull and second is bear. Bears are the pessimistic people, those people who want the share prices to go down, and they generally keep on selling the shares. On the other hand, there are bulls. Bulls are the optimistic people who thinks that the prices will go higher, economic will do good, shares will do good. So generally in stock market we want more bulls. We want more optimistic people. So that's why even in front of in Bombay Stock Exchange you can say bull. Even in New York Stock Exchange in front of that also there is bull. So basically they signify the type of the people and what we want from them.
Which is the markets to go up always.
Okay. There's a famous way also how these animals work, how the bulls and bear are defined. So bulls are basically the ones who hit you from their horns, right? They try to lift you up.
Yeah, and take you up.
Take you up. So that's why in the market are the people, bulls are the people who want to take you higher.
Okay.
That's why because of that they are called bulls. On the other hand, bears generally hit you with your claw. So they will want to keep you down.
And bring the market down as well.
Bring the market down. So that's why bears are signified with pessimistic people.
People who are short selling the market.
Short selling the market, wanting the shares to go down.
Okay, so there's just two animals in the stock exchange. We'll get into the other ones later ahead.
Yes. Yeah, there are a lot of animals in the stock market, but we will discuss it in the upcoming videos.
So we're coming close to the last few questions. Yes. What is trading and what is investing? Why are they different?
Okay. So investing is basically buying the shares and holding for the longer duration. It can be anything more than 2 days, 3 days, 5 days, 5 years, 50 years. So anything with a longer vision is known as investing. So let's say if I buy shares of Reliance Industries today and I'm planning to sell it 6 months back, 6 months after, 1 year after, it's called investing. On the other hand, trading is basically buying and selling the shares on the same day. So previously we discussed about the stock market timings.
Yeah.
It's between 9:15 to 3:30.
Yeah.
So traders are those people who will buy the shares in the start of the morning and sell it by the end of the day before the market closes. So they want to book profit in the day only. Profit or loss, whatever happens, they will book in that day only. So generally trading is considered as a full-time job. If you are trading in stock, you need to be stand in the front of the laptop, and here it's not like you have to give proper time, proper attention. Market moves very rapidly, so you have to capitalize the moments and all. On the other hand, investing is generally a secondary job. So here you will buy the shares and you can relax that you are holding for a very long time and all. So there's a difference. But another distinct difference is that generally investing gratification is longer. Like to put the profit, you might not be booking it instantly. You have to book profit after 6 months, 1 year, 10 years. In trading, like whether you have made money or you have
lost money.
Whether you have made money or you have lost money, it's in same day only. So that's the advantage also. And for like in investing, a lot of time will happen that you will buy a share and it will not move for the next 2 to 3 years.
Yeah, that will of course.
That will happen, and here you have lost 2 years. Like there was no movement, you have lost time and all.
Yeah.
Trading is instant.
By 3:30, I know if I made money or not.
So it depends on like what kind of people you want to be. Whether you want to take it as a second. If you have a job and you cannot give that much time, you can give your weekends to research companies. Take your time to find good companies and invest. So investing is best for those people who want to treat it as a secondary job. And like I said, trading is mostly should be considered as a full-time job only.
You have to be there. Yes.
You have to be there, yeah.
Big difference.
Big difference.
Yes. I think we have like maybe 1 or 2 more questions, and then yes. Yes. I think this is one of the last few questions. I'll leave the best for the last, but for now we'll do something basic. What is the meaning of dividends?
So if you are a shareholder in a company, the company wants to reward you with the profits that they are making. So let's say if a company made 1,000 crores of profit in a year, they can give a small portion, let's say 100 crore of their profit, and distribute it among all its shareholders. So the portion of the profit that you received because you are a shareholder is known as dividends. For example, if you are holding 100 shares of a company, the company can give you rupees 5, rupees 6 as dividends, and because rupees 5, rupees 6 per share. So let's say it's giving rupees 5 per share and you are holding 100 of those shares, you will get 500 rupees directly in your bank account by not doing anything, just because the company is making profit and you are a shareholder.
Yeah, and you held the shares and they're rewarding you.
Yeah, so it's just a way of rewarding the company to its shareholder. Most of the big companies, blue chip companies, large cap company, they make profits in crores and all, lots of crores and all, and they reward their shareholders consistently. So this earnings that you get is known as dividends.
This also like gives people a reason to buy the share. Like they're giving me dividend regularly, so I want this share. That type of mentality.
Yeah, that's one of the biggest reasons. The thing is like if you're investing, you're not making any money until you sell the shares.
Exactly. Yes.
Say you have bought shares today and you are selling it for 5 years. There's nothing in between. But if it's a dividend stock, if it's giving you dividends, even if it's 5, 10, anything, you are earning some money just because you are holding that stock between that 5-year time period. So most of the companies will give you 1 or 2 times dividend in a year, final dividend, interim dividend. So 1 or 2 times for that stock every year you will receive dividends. So yeah, that's a way. Without doing anything, you will get credits in your bank account.
Yeah, this is also something called dividend investing, which you can check out in the next video as well. Okay, the last question. It's the most interesting. How fast can I learn trading or investing?
Okay, first of all, it depends on how much time and efforts you are putting.
Yeah.
Like if you are giving just half an hour a day compared to another person who is learning 8 or 9 hours in a day, they will obviously learn faster compared to you. But still, it can easily take like anything between 6 months to 1 year to learn most of the things related to stock market. A lot of things cannot be learned just by reading text or watching videos. A lot of things is also related to experience, how much time you have invested in stock market. So those can only come with experience, like maybe a market crash. If you have not seen market crash in your investing career, so that generally happens like once in a 10-year time frame. So most of the new people, they wouldn't have seen the crash of 2020 or the 2008 crash and all. So if it's something like this happens to them, even if you have learned all the theory, you won't know how to behave, whether to purchase, whether to sell and all. So generally it will take time, 6 to 12 months if you are dedicating proper time, learning everything and all. But if you think that you can do it in 1 month or 2 months, it's not possible.
Yeah. So on that note, we are also having our own courses that can help you with these knowledge that you want on trading as well as investing, that you can take up on your own time whenever you want. So the classes are pre-recorded and you can check it out on Join FinGrad. So
yeah, do check it out. We have more than 60 courses and webinars on everything that you want to learn, from fundamental analysis, technical analysis, options trading, futures trading. Everything that you want to learn is available there. So yeah, check out our description or directly go to joinfingrad.com.
Well guys, that's all for part 1. Sitting with Kritesh here for stock market FAQs. We hope you like this video, and if you did, we'll know as well, and we'll come out with part 2 as soon as possible. Thank you for watching.
Thank you so much guys. See you soon. Bye.